Hi, this is John Gatewood, founder and CEO of Gatewood Wealth Solutions, where we are on a mission to help individuals and families become and remain financially self-reliant. Welcome back to our weekly Market Insight broadcast and our guest, our weekly guest, host, me,
co-host?
Aaron Tuttle.
Am I co-host?
You're the co-host. So Aaron, of course, is our Chief Investment Officer, and he runs all the portfolios and the portfolio managers. And today we're going to talk about things that we've been talking about in the news, which is
Inflation. Absolutely.
And what's causing all this? And is it here to stay?
Well, we keep hearing that word transitory, right, from the Federal Reserve, and many probably know that we disagree, but then I guess it's always transitory. At some point it will stop.
Right, transitory meaning that they say that this is only going to be here for a period, and then it's going to kind of go back.
Right.
But we don't believe that that's going to be the case.
At least the risk of it not being the case is pretty significant, and what evidence that we're seeing is that's probably less likely to be the case. What we should see, so the bottlenecks from supply chains, specifically in the shipping industry, should be decreasing going forward. So that's going to play less of an impact. But I wanted to spend a little bit of time on what's going on there.
Yeah, because that's an interesting topic. How actually is that occurring, and how's that going to unwind itself or fix itself?
So TEUs or Connex boxes are, I think it's 20 foot of whatever unit, so each one of them is a certain amount. You can only really take one off at a time. And yes, they have cranes that they can do multiple. But if you have an increase in the amount of shipping coming in, you can't just easily expand throughput. So there's always going to be a line if there's an increase. And if we look at the amount of imports coming into the United States, we are not only back to where we were prior to the coronavirus lockdown, but we're 20% higher. So on imports. Makes sense because a lot of the domestic spending or service economy, restaurants and other things, that's money that is going to be spent elsewhere, and if it's spent on products at home, a lot of those products are made overseas. So there was a 20% increase in imports.
So in other words, you would expect a slowdown from the fact you have that many more of those containers, but you can't take them off any faster than what technology allows them. Right?
Correct. And we've actually added a lot of ships through the correction. So we've been for quite some time increasing the capacity of shipping through larger and more ships. So there is the ability to get them in there, but then you're going to get a bottleneck at the port because there's only so much a port can handle. At the same time, our exports have actually decreased. So it's not just a problem of having too much coming in, is what do you do with those shipping containers? How do you ship them back out? And the exports usually will house whatever goods are made here in the United States and send them out. So where we had a 20% increase in shipping containers coming in, we have a 20% decrease in shipping containers going out.
So what happens to those containers then? And I suppose that there's some type of cost. You either send them overseas empty, and who absorbs that cost?
And a lot of what we export is services, so we don't ship out tangible goods. Right or wrong, we shipped out a lot of the manufacturing base in the 90s to China. So there's not a lot that goes into these. So there's typically about 80 or 50% of the 85% of the containers go back with something in them. It's now at 50%. And there is a large amount here in the U.S. and not enough in China, which is creating an increase in prices for these shipping containers. And other creative people, some people actually have abilities to make homes out of these because there's usually a decent amount. But there's definitely a problem with the shipping containers getting to where they're needed, which causes shipping delays because you can't ship anything unless it's in one of these Connex boxes or TEU.
So are there certain areas of the economy where that impacts prices more than others? What would be your opinion on that?
Well, it's a broader cost. It's a general cost for shipping because it doesn't matter if you're shipping cars or if you're shipping the styrofoam peanuts, whatever it is, it has to go into one of these containers. It's so actually I had to inspect these whenever I was in the Marine Corps. One of the things as a part of the Marine Expeditionary Unit is you got to be able to take your mobile facilities, put them on a ship, and get them anywhere in the world quickly. So I was certified in inspecting these. So there is specific global regulations that you have to follow for containers going on ships, and these are the only way that you can ship things other than like oil tankers and other things that are on a separate container. But if it's got to be put in a container, it's got to be one of these boxes.
Amazing.
So that's not the only problem, though. Once you get the boxes off, there's actually very long lines to try to get the shipping container moving, and there's been a shortage of truck drivers. One of which, during the lockdowns, truck drivers, like everyone else, some of them were dealing with sickness, and then you're going to have people out doing the work from home, or I guess for them, their case, they're not working anything.
Well, it's interesting because this morning I was listening to the CEO of Dot Foods, and they're a big food distribution company. And one of the things that they were talking about is, so they have a logistics company. They've got like 1,250 trucks across the country. But they're having problems finding drivers because the average age of a driver now is 52, and you don't have new people coming in. So it's actually driving up the wages and putting pressure on pricing.
Right.
So I suppose that's another factor that's going to go into this. So in other words, it's not really as transitory as what the Fed may say, because this is a problem that is more ingrained in
it's structural.
Whole industry.
It is structural. There's a labor shortage for trucking. There certainly is not a shortage of a need for trucking right now. There's a huge need as we are importing more, and they all need to go on these boxes. But you're correct that the labor shortage was there prior to this just made it worse through that, and it's probably not transitory there. Another thing is the higher the price to ship these Connex boxes isn't necessarily solving the problem. So one thing in a competitive market is you need these moved. You just increase the price that you'll pay to move them, and that should resolve it. Well, because of the way that the throughput works, you end up waiting in line to try to get to the boxes, which causes delays. And then whenever you look at the amount of time spent trying to pick these boxes up, you're actually at a loss. So the price system isn't necessarily working at the moment, considering the delays. And the delays are not just in the shipping area or even the rail, because typically they'll go into the country on rail and move quicker. But there's bottlenecks in the rail industry as well that is causing delays, and they're trying to ship it, meaning that more truck drivers are being used for domestic or internal transportation, rather than just the rail lines taking them as well. But it's not just rail lines, airlines. So there's obviously been a drop in global travel through the lockdown, especially with all the travel restrictions placed on countries by other countries. So one of the issues is air freight. Almost all of it goes on passenger planes. So that's one of the ways that the airline will make money is, and why you're limited to only so many bags, is because all the extra cargo space that passenger plane has is filled up with air freight. And I've heard Delta doesn't expect air travel to return, which is usually business travel, and back to pre-COVID levels until 2024.
Right.
So that means all of that cargo needs to go a slower route by ship as well. So there are a lot of issues. Now, there is light at the end of the tunnel.
That's good news.
Because we are opening. And one of the reasons that we have such an increase in imports is because those dollars are not competing to go out to eat, to go to the barber, do all the things that are service related, and instead we were bringing more goods that were imported, tangible goods. So as we open up, some of the demand for imports will decrease as the dollars that are being spent by people get shifted to more domestic service related
Well, so that's
purchases.
interesting. So really, people are spending money, but they're deciding to spend it on goods as opposed to services.
Correct.
But now that the services are opening up, restaurants, barbers, whatever, so would we expect then to have a let's say, fewer imports in the future if that shift actually happens?
It should
to services?
reduce and go back to where it was the pre-pandemic. Obviously, habits have changed as well, so it's yet to be determined. But we're starting to see price increases in wages, not just in the trucking industry, but in the service industry. So there may be some more costs, then there would be less. Even if you went to dine in a restaurant fewer times, the amount of money that it'll take should dampen the amount of imports.
I mean, once prices go up, what's the chance that they'll even go down in the future?
Well, that rarely happens unless you're in technology, right?
That's kind of what I'm concerned about in terms of the long-term effect of this, because I think this would be more permanent.
Yes, so a lot of people were excited and happy in the financial market because corn dropped 6% a day or two ago. So the futures, and that was finally a reprieve, finally a pullback in commodity prices. And it's welcomed. But that doesn't do anything from the 96% increase that we've had.
Right.
So it's like we're probably not going to reverse back to pre-pandemic levels on a lot of these commodity prices. So you didn't see this slide in your packet because I grabbed it this morning. But this is showing that we are seeing that drop in the length of time that ships are sitting in anchor waiting to be disembarked of their goods. So we are seeing that. Now this is talking about, it's coming back. We don't see that. It's just kind of noise. It's going to continue to decrease. But areas that we will probably not see prices, and the point is that this shipping may be transitory, but there are other waves of inflation that we're going to see. And it's not just monetary policy, it can be federal policy, tariffs. So just recently, the U.S. government, or just yesterday, announced that they were going to double the tariffs on soft wood imports coming in from Canada, lumber to build homes.
Yeah, well, that's already been hit very high, right? Lumber prices are much higher than what they were because of the...
I think pre-pandemic, they were $396 per thousand feet of lumber, and I think we're at $1,700 per thousand. So it's added $36,000 in additional costs to build a home. Yesterday, we got news of that there was a decline in the amount of sales for homes, and a lot of people think that that's going to be a drop. Well, it's true that there were less homes sold, probably because we're not creating as many because the price for lumber and other material goods is so difficult to procure, because the price was up about 13%. So it's not that there's a softening demand for homes, there is a softening supply for homes. And this is only going to exacerbate it. By the way, the people that build the homes, their wages obviously are going up because they need as many carpenters to build the homes as they can get at the moment with the demand. It's often the same labor pool that are competing for the trucking jobs. So they're competing for basically the same worker.
So it's sort of the same phenomenon that had happened in the car business, right? So you had this supply slowdown because of the supply chain problem, and so the used car prices went up. So now everybody that owns a house that wants to sell it, their prices are going up because of the lack of supply on the new home side.
Right, and less people are less likely to sell their used car or their current home because they know they got to replace it. And it's not easy to replace at the moment.
Right.
So then the supply gets shrunk a little bit further. So it is a problem, and we think inflation is not transitory. We don't know how that it's going to go for years, but we don't think that as the supply chain fixes itself that that's the final and last wave of the inflation cycle. We think that there are several, one of them being wage increases that has yet to really start to move prices up. So what do you do?
What do you do?
How do you protect
where do you invest when you have all of this? Because as we've talked about, it's not preservation of principle that we're after, it's preservation of purchasing power. So now we were actually in the phase that we've been predicting that we would have inflation, which now hurts your purchasing power of the dollar.
Right, and there are plenty of problems within the economy. We definitely see the valuations are stretched in equities. But let's look at the risk, because most people are looking at their one-year term and they look at stocks. So stocks is the bar on the left. We can see it here, stocks, bonds, T-bills, and there's a 66% upside in any given year or there could be a 38.6% loss in any given year on a 1-year time frame for stocks. So pretty wide variability within the returns, where a bond could be up 35% and it could be down 21%. Still,
So
21% is
what
still a
are
significant.
these? Are these the extremes of the market?
Yes, on the historical periods, it's going back and looking. Okay, if you have a 1-year holding period, what is the range that they're going to fall in?
What's the best year and what's the worst year for the market?
I think this is going back to 1802 to 2012. I know a lot about markets, especially current. I can't tell you much about the 1812 panic.
Well, at least we know that we're going back far enough.
I know there was an 1812 panic. There's a big data set here, and it's pre-central bank as well as post-central bank. And we've had 3, by the way. I've noticed a couple of people talking about this central bank as if it's a new paradigm. The country's had 3. No, that's not really useful, but I've just noticed a lot of people commented on that in the media. So if you look out 2 years, still stocks are more risky than bonds.
So
at 5 years,
so at 21% at 2 years, or minus 15% at is that 3 years, 5 years?
5 years, stocks could be down 11.9% on a 3-year holding, where bonds could be down -10. So it's about 1 to 2% difference on the downside, with much greater upside, about 10% greater upside for stocks. So it's not to say that you shouldn't have bonds or you shouldn't have cash, because if you have a 1-year, 2-year, 3-year horizon, that's the point of our cash hub. Let's insulate some of that risk by holding the cash that you would need during that time.
So basically what you're saying is that there have been 5-year periods, or there has been a 5-year period, where stocks lost 11% and bonds lost 10%.
Yes. So comparatively, not that difference on the downside. But look at what happens by the time you're at 10 years out. And these are real returns, so they're taking the inflation out. Where stocks on a 10-year, worst they've done is -4% real, where bonds and cash were down more than 5%. So at 10 years, it's no longer that stocks are more risky than bonds for a holding period.
Well, the interesting thing, I think, for us, and at the point in time that we're at, is what is the actual risk of bonds because of the low interest rates?
Yeah, this is just, and looking back over 200 years, what do we talk about specifically? And we'll get into that on the specific time frame. But at 20 years and 30 years, notice that there are no negative real returns in the data. That doesn't mean it can't happen, but there are no negative real returns in stocks. And there are negative real returns in bonds and cash at 20 and 30 years out. And somebody that is 70 years old absolutely has a higher probability, because the older you get, the further out the likeliness or the average age gets, because you've lost some of the people that would have lost earlier. So at age 70, I don't know the number, but I bet it's approaching age 90 for expected life expectancy.
Yes.
So at 70, there's no reason that 20 years, and it doesn't matter at 10, and certainly 80s very likely, stocks are better. So you want to have some cash, you want to have bonds, because the 1, 2, and 3 could happen over the next few years. But you're going to protect yourself. Risks are less, or stocks are less risky if you start to get out to that 10-year horizon. And it's really not that different at the 5.
Well, again, to highlight our cash hub, is the fact that we can have periods that are extended where any of those holdings are going to be negative.
Yes.
And that's why we have to have cash, so we're not forced to liquidate at the wrong time.
So here's a book I've mentioned last time was Jeremy Siegel, Stocks for the Long Term. We wouldn't advocate everything, because he's saying you only buy stocks and just have a little bit of cash. We do think bonds do have a place in portfolios as a ballast. But if you want to become and remain financially self-reliant, it's going to be stocks that get you there. And he's looking at a period from 1802, and this data is a little bit old, 2013. It's still there. And if we look at that time period where we see a real return, so after inflation, stocks have performed at 6.6% long-term, where bonds, 3.5% long-term. I don't think that's too surprising to people, but let's look at the sub-periods. So 1802 to 1870, there's a partial First National Bank, and then there's another 20-year period where we have a Second National Bank. But most of that is what's known as the free banking era. So there's not a big central bank moving the interest rate. It was more market determined. Now there were wildcat banking.
This is all before the creation of the Fed in 2013.
Of the third central bank, correct.
Right.
So we can see that bonds during that period paid 4.8 versus stocks 6.7. But if we go to 1871 to 1925, kind of that Gilded Age, 6.6 to 3.7. The states would sponsor banks, so there was different flows. It had problems, but you can see that the state-sponsored banks were helping keep interest rates lower in each individual state. So bonds were suppressed then. And then we get a central bank, so 1926 to 2013. It's not perfect. 1913 is the era that our central bank started, but we can see that since then, with the central bank being able to expand the money supply, if you expand the money supply, you have more savings in the loanable market, you're going to see interest rates lower. So bonds have actually not been able to keep up with the same types of return, 2.4 versus 6.6. And notice that 6.6 is consistent for equities. Why? Because over the long term, inflation does hurt stocks. It hurts all assets except maybe real estate and gold during inflationary times. But stocks will weather inflation better than others because over enough time, their output and input costs can balance out. They can increase prices, it will average out, so that then they'll end up getting back to what is an equity premium, which is 6.7%.
If you think about our audience, people that were born, or at least adults where they could experience the market starting in 2000, they've seen the low interest rate environment where interest rates would go to zero, where my generation, the baby boomers, we were here in the late 70s, early 80s when the Fed fund rates went as high as 20.5%. So you had money markets out there paying 23%. So how do you coordinate or understand that relative to the lower interest rate in this federal central banking system?
So there are a couple of periods, and you hit the two periods that we're going to cover. We have the baby boomer experience, then you have the silent and hero generation experience. So if we look at the post-World War II periods, and this is kind of where people say, okay, the central bank knows what it's doing at this point. So if we look at 1946 to 1965, bonds did negative 1.2%, where stocks did 10%. And then you get in the high inflation era of the 60s all the way up to the beginning of the 80s, stocks did negative 0.4%. So no real return. There was inflation, but no real return for stocks. But look at bonds, negative 4.2% over that time period.
How do you compare that, or how do we understand that when we're thinking about the high interest rates? In other words, if my real return was minus 4%, what does that mean?
So we're going to get there. But we're looking at...
I'm setting you up.
It's okay. I appreciate it. We're looking at the effective federal funds rate, and this would be the 1960s, so you could see interest rates were low, very similar to where they are now. We're lower now, but they were considered low interest rates during that era, too. And we can see the 66 to 80s where interest rates were substantially higher. So then how do we compare that? And this is... So now let's compare the CPI, inflation, versus the Fed funds rate. So if we can see the 60s, that era, the Fed funds rate was low, between 1% and 5%, and CPI tended to be below that. Right? And then going forward, as bonds moved up, that's going to put downward pressure on bond performance because interest rates are moving up. So that's going to cause that negative 1.2. When we get into the next era where interest rates are climbing substantially, where they get up to 20%, that's putting a lot of downward pressure on the price of bonds. So are we going to see a negative 4.2%? We'd have to go to 20% probably. But just let's say the better comparison is in the silent generation's experience. Let's look at where we are today. So inflation is below a low interest rate. Look here, the blue, inflation is above a low interest rate. So we already know that going forward for all these bonds, if inflation stays where it is, the coupon rate has been well below it, we're probably going to have something closer to the baby boomer generation of bonds because the yields aren't as high and the inflation is already higher than the yields.
Translating that into layperson's terms, that means that you're losing purchasing power if you're in bonds.
You're already losing purchasing power in bonds now. If interest rates move up, you're going to lose par value, or the value of your bonds are going to drop further, competing with the new interest rate. So you're going to see a drop in the value of bonds more than just the inflation loss. So this is one of the reasons that we've continued to caution holding fixed income despite having the enormous amount of negative news in the valuations that we see in the market, because those equities are stretched over the long term. They will generate 6.7%. We can see that bonds have continued to go down over time, especially with a central bank that's providing liquidity, driving the interest rate down so far now that even what's known as the Fisher equation, where you have an inflation premium above the natural rate, isn't even there as it exists. So we think bonds are going to really struggle to maintain their purchasing power. They're already behind the curve, and if interest rates move up, that's going to put them further back.
It's easy to understand that you're losing purchasing power on bonds, and that over the long term you have the potential for preserving your purchasing power. The scary part for most people is that interim drop, right? That 38% drop in 1 year.
And that certainly is a possibility. It's going to happen again. It's not if there's a bear market, it's when there's a bear market. So that's the importance of not abandoning bonds altogether. Having a cash hub so you can meet those cash needs is important, and having some fixed income, because it was out to 5 years, you still had some negative returns, so that will help cushion some of that. So we have some areas, but it's the equities that are going to drive the performance. And even though equities are stretched, they're not nearly as stretched as a valuation of bonds at the moment.
I know that when we talk about historical performance, we're looking at averages and the comparison of equities versus bonds. Are we in a different period because we're now in this modern monetary practice?
So are we in a different period? So history never repeats itself, but it often rhymes. So the laws of economics are also universal. So it's going to play out differently for sure. But there's also some principles that we can rely on, and we can look back to history to see how those principles played out. Beyond that, there's really not much you can do, right? There's no crystal ball that says this is exactly how it's going to play out.
So how are we doing on the pricing of
the
S&P?
The S&P continues to climb that wall of worry. We bounced off the 15-day moving average, which we talked about last week. Haven't made a new high since that time, but we can see that that's probably going to be challenged coming up. If we look at what asset classes are doing well, gold is really moving, as well as commodities, and the S&P 500 has been dropping. We've been making some changes, especially in the taxable accounts, where we've been very much in growth, and you can see, they may not be able to see it, but growth is further down, so it has been underperforming as of late, and we're continuing to make those changes, but we don't want to, there's some positions that have 80% gains in them, so we don't want to go and realize those because that's a big tax hit, especially since we do think that the growth side of the market, a year, 2 years, 3 years out, is actually the bull case. We just have to get through this transitory period as inflation is moving up for the next couple of quarters.
So that's a really important point because you want to be patient.
Yes.
So even though the index may have outperformed the accounts for the moment, what we don't want to do is to realize a lot of taxes, but we do believe that over the next few years we're going to catch up, and that's where the ultimate gain is going to be.
So we can see our tactical mutual fund, we would love to be able to say we're at almost 16% year to date on the tax sensitive side. But we are able to make a lot more changes without realizing taxes. But we would have probably given up 10 to 15% in tax liability if we were making the same changes in tax sensitive as we are in tactical mutual fund. We've seen this value rotation for most of the year. Last week was actually a rally in the growth names. So we added about 22 basis points against the benchmark in tax sensitive. So we're seeing that rotation. We continue to move a little bit further, but once again, we think a year, 2 years out, growth will be the story again. So we don't want to go to value just to unwind those trades to go back to growth and pay Uncle Sam a toll, especially since it could be likely that that toll increases with any changes to the tax law. Also, let's notice that equities, the benchmark's up 11.5% year to date, but look at qualified fixed income, down -2.5%. So we're already seeing that effect on fixed income as interest rates begin to move up. They're already negative. In a tumultuous year, in a year that everyone wants to be out of the market, it seems, bonds are not the place to be this year.
Well, it looks like our bond portfolios are doing well relative to the benchmark.
Yes, we look more like cash than we do the index. It looks more like a long-term bond compared to us. So that's helped offset any rise in interest rate because it doesn't push the price of the bonds down as far.
Well, it looks like we're out of time today, and that was very interesting on understanding the whole story behind the logistics that are causing the supply chain disruption and how that's going to increase prices of lots of goods.
Well, hopefully the supply chains are not as disrupted over the next couple of months, but then we still have other factors that have yet to play out in the market.
Well, thanks again for joining us today. As always, our goal is to give you our perspective that is data-driven, based upon what our economic views are of the economy and the market, to give you some actionable advice for your own financial needs. But thanks again, Aaron, for joining us today. And if somebody wants to learn more about us, how can they do that?
Well, they could visit our website and click the button up top saying that you would like to request, is it a demo? I don't remember the language there. But there's a button to request information. You could also call us at the number, I think you know the number.
314-394.
No, 924.
924.
So you don't know it. 5100?
5100. There you go.
All right.
It's on our screen. I just can't see the screen right now.
And if you want to send this video to any of your friends, click down below. There's an arrow. Send that link over. While you're down there, make sure you like it if you enjoyed this call, and subscribe if you're not subscribed.
And we look forward to having you back again next week. Thanks again for joining us today.